Picture this for a moment. A company that sells happiness in the form of ice cream, a brand recognized in freezers across continents, freshly independent, freshly listed, and still finding its footing in the unforgiving world of public markets. Now imagine this, while most investors are celebrating the story, admiring the brand, and chasing the narrative, someone else is doing the opposite. Quietly, deliberately, with 50 million pounds on the line. This isn't noise, this isn't speculation, this is conviction capital stepping into uncertainty and saying, the price is wrong because markets don't move on emotion forever. They move when optimism meets reality. And right now, beneath the headlines, beneath the brand loyalty, beneath the excitement of independence, there is a deeper question forming, one that very few are asking, and even fewer are prepared to answer. What happens when a beloved consumer icon is stripped of its parents' protection? What happens when costs stand alone, margins are exposed, and expectations are no longer shared but owned? What happens when a new stock enters the market before the market truly understands it? This is where fortunes are made. This is where narratives break. This is where confidence is tested. Because the biggest moves in finance don't happen when everyone agrees. They happen when someone sees risk where others see comfort and has the discipline to act on it. Today's story is not about ice cream. It's about timing. It's about structure. It's about what happens when certainty is priced in too early. And by the end of this video, you'll understand why this moment matters, not just for one company, but for how markets really work when the spotlight fades and the real game begins. Stay with me. When a hedge fund commits capital at this scale, it is never impulsive, never emotional, and never symbolic. A 50 million pounds short position is not a headline move. It is a statement of analytical confidence. It reflects months of research, thousands of data points, and a very deliberate conclusion that market pricing and underlying reality are temporarily out of alignment. This is how serious capital moves, quietly, precisely, and with full awareness of the risk on both sides of the trade. A short position of this magnitude sends a clear signal to the market. It says that valuation matters. It says that timing matters. And most importantly, it says that newly listed companies, no matter how iconic their brands, are not immune to scrutiny. When a company transitions from the protective structure of a conglomerate to the open terrain of public markets, it enters a period of vulnerability. Financials are re-examined, margins are stress-tested, growth assumptions are challenged, and optimism, which often dominates the early days of a listing, is measured against cold, unemotional numbers. This is not a judgment on the quality of the product or the strength of consumer loyalty. Markets do not reward nostalgia, they reward cash flow, discipline, and scalability. A newly independent business must prove it can stand on its own balance sheet, manage costs without cross-subsidies, and defend margins in an increasingly competitive global environment. The moment a company lists, it stops being a story and becomes a set of expectations, and expectations are where risk lives. Large short positions also reflect an understanding of market mechanics. Liquidity dynamics, index inclusion timing, and passive fund behavior all play a role in how prices move after a spinoff. When shares enter the market without immediate benchmark demand, selling pressure can emerge regardless of operational performance. This is not speculation, it is structure. Sophisticated investors don't just analyze companies, they analyze how markets are built around those companies. Taking a position like this is not about predicting collapse. It is about identifying asymmetry. When downside risk appears mispriced and sentiment runs ahead of fundamentals, opportunity emerges. That opportunity is not permanent, but it can be meaningful. The goal is not to be loud, but to be right. Capital deployed at this level demands accountability, rigorous risk management, and a clear exit strategy long before the first trade is placed. What matters most is discipline. The discipline to go against prevailing optimism, the discipline to trust research over headlines, and the discipline to act when probabilities, not opinions, are in your favor. This is how markets stay efficient. This is how price discovery works. And this is why, when a move like this appears, it deserves attention. Not because it is dramatic, but because it is deliberate. A corporate spinoff is often celebrated as a moment of liberation, a chance for a business to unlock value and tell its own story to the market. But seasoned investors understand that separation is not an instant victory. It is a transition, and transitions are where uncertainty concentrates. When a company steps out from under the umbrella of a global parent, it must immediately prove that independence enhances performance rather than exposes weakness. The market's first reaction may be enthusiasm, but enthusiasm is temporary. Execution is permanent. The moment a newly independent company begins trading, every line of its financials is repriced in real time. Costs that were once shared now stand alone. Procurement advantages are tested. Corporate overhead that was previously absorbed must now be justified. What once looked efficient within a diversified group can appear less so when isolated. This is the reality of independence, and the market is relentless in measuring how quickly leadership adapts to it. There is also a psychological dimension to a spin-off that investors do not ignore. Early trading is often driven by forced behavior rather than voluntary conviction. Some shareholders receive the new stock without ever asking for it. Others are restricted by mandates that prevent them from holding a single sector or newly listed company. These dynamics create supply before genuine price discovery even begins. In those early weeks, the stock is not being judged solely on its future. It is being shaped by mechanics. A newly listed company also faces the challenge of redefining its narrative. While it may carry globally recognized brands, public markets demand more than recognition. They demand guidance that is conservative but credible, targets that are ambitious but achievable, and communication that is transparent under pressure. The first earnings calls are not performances, they are examinations. Every assumption is questioned. Every deviation is magnified. Operationally, independence compresses time. Decisions that once moved through layers of a parent organization now land squarely on a new executive team. Capital allocation becomes more visible. Mistakes become more expensive. The margin for error narrows precisely when expectations are at their highest. This is not a criticism. It is the natural consequence of accountability. Markets respect companies that manage this transition with discipline, but they punish hesitation and reward realism. Spin-offs that succeed are not those with the loudest debut, but those that quietly meet their numbers quarter after quarter. Until that track record is established, valuation remains a hypothesis, not a fact. For investors who understand cycles, this period is not about belief, it is about verification. Independence creates opportunity, but it also creates exposure. And in markets, exposure is never ignored for long. Valuation is not a number pulled from optimism or brand recognition. It is the price the market assigns to future discipline. When a company enters public markets with a multi-billion euro valuation, it inherits expectations immediately, whether it is ready for them or not. At that scale, every percentage point of margin, every shift in demand, and every cost input matters. The market does not ask whether a company is admired, it asks whether the valuation already assumes perfection. Index inclusion is one of the most misunderstood forces in modern markets. Many investors assume that once a company lists, demand naturally follows. In reality, a significant portion of market demand is mechanical. Funds that track benchmarks can only buy when inclusion criteria are met, and until that moment arrives, those buyers are absent. What remains is a market driven by active capital, sentiment, and supply dynamics, and that environment can be unforgiving. When a newly listed company is not immediately included in major indices, the early shareholder base becomes unstable. Some investors are transitional holders, not long-term owners. Others are arbitrage participants seeking short-term price movement rather than fundamental exposure. This creates volatility that has little to do with the business itself and everything to do with structure. Sophisticated investors pay close attention to this phase because it often reveals price dislocations. At a valuation approaching €8 to €9 billion, the margin for disappointment narrows significantly. Growth must be consistent, not episodic. Costs must be controlled, not exploit. INED. The market does not grant time simply because a business is newly independent. If anything, scrutiny intensifies. Every earnings release becomes a referendum on whether the valuation was justified or premature. Volatility in this context is not random. It is the market recalibrating. Without the stabilizing effect of index-linked demand, prices respond more sharply to news, guidance, and shifts in outlook. This is where experience matters. Investors who understand liquidity, float size, and passive fund timing can distinguish between noise and opportunity. This phase also exposes a deeper truth about public markets. Valuation is not static. It evolves as information improves. The early months of trading are about discovery, discovering how the company performs without support, discovering how management communicates under pressure, and discovering whether early assumptions were conservative or generous. Markets are not patient with uncertainty, but they are precise in correcting it. When valuation runs ahead of confirmation, it rarely stays there for long. This is not a judgment. It is a function of how capital allocates itself. Price is simply the market's way of asking questions. And until those questions are answered with consistency, volatility remains the cost of admission. Analyst opinion is often mistaken for consensus, but in reality, it is a reflection of uncertainty expressed through different lenses. When a newly listed company enters the market, coverage begins with models built on assumptions rather than history. Revenue forecasts rely on limited standalone data. Cost structures are inferred. Margin trajectories are projected without the benefit of a long, independent track record. In that environment, divergence is not a flaw. It is inevitable. Some analysts see focus as a strength. A pure play business can allocate capital with clarity prior. It ties its most profitable segments and operate without internal competition for resources. From that perspective, independence creates strategic freedom. But freedom comes with exposure. Others look at the same structure and see concentration risks, seasonal demand patterns, and sensitivity to input costs. Both views can be rational at the same time. Markets exist precisely because disagreement exists. What matters is not the rating itself, but what sits underneath it. Analysts who lean positive often assume that brand power translates directly into pricing resilience. Those who are more cautious question whether that resilience holds in an environment of changing consumer behavior, inflationary pressures, and intense competition. Neither side is guessing. They are weighting probabilities differently. Early coverage also shapes narrative momentum. Initial reports influence institutional perception, and perception influences capital flow. But experienced investors understand that early analyst sentiment is provisional. Models evolve, targets change, guidance is revised. The first year of coverage is less about conviction and more about calibration. There is also an important distinction between long-term belief and short-term risk. An analyst may see strong multi-year potential while acknowledging near-term valuation risk. Markets often struggle with this nuance. Stocks do not trade on distant optimism alone. They trade on what can go wrong before that optimism materializes. This gap between promise and proof is where volatility lives. The presence of mixed analyst views should not be interpreted as confusion. It should be seen as the market doing its job, testing assumptions from every angle. When opinions are aligned too quickly, risk is often underappreciated. Disagreement forces discipline. It forces management to earn credibility quarter by quarter, not press release by press release. In time, results resolve debate. Cash flow clarifies narrative. Margins validate or challenge projections. Until then, analyst divergence is not noise. It is information. It tells you where uncertainty is concentrated and where expectations may be fragile. Markets do not reward certainty, they reward accuracy, and accuracy is only achieved when opinions are stress-tested by performance. Until that happens, differing views are not a weakness in the system, they are the system working exactly as it should. When a parent company retains a meaningful stake after a separation, it creates a relationship that is neither fully detached nor fully integrated. It is a strategic tension that markets pay close attention to. A retained holding signals confidence, but it also extends exposure. Performance no longer belongs to a consolidated balance sheet. It becomes a visible, mark-to-market reality. Every movement in the newly independent company's share price reflects back, subtly but persistently, on the parent's valuation and investor narrative. For shareholders of the parent company, this connection matters. Capital that was once diversified across a broad portfolio is now partially concentrated in a single standalone business. That concentration can be beneficial if execution exceeds expectations, but it also amplifies downside risk if early performance disappoints. Markets do not separate these outcomes cleanly. They price the relationship as a living variable, adjusting confidence in real time. From a strategic perspective, Retaining a stake limits optionality. Decisions around monetization, governance influence, and long-term alignment must be handled with care. The parent cannot fully distance itself from operational outcomes, nor can it fully direct them. This balance requires discipline and clarity of intent. Any ambiguity invites speculation, and speculation invites volatility. There is also a signaling effect at work. Investors scrutinize retained stakes for clues about internal belief. Is the holding a vote of confidence in long-term value creation, or is it a transitional position awaiting favorable exit conditions? Until that question is answered through action, uncertainty persists. Markets are uncomfortable with unanswered questions, and discomfort is reflected in price behavior. As the newly independent company establishes its own rhythm, reporting earnings, setting guidance, navigating competitive pressures, the retained stake becomes a conduit through which market sentiment flows. Positive surprises strengthen credibility for both entities. Missed targets, however small, create second-order effects. The parent's strategic judgment is quietly reassessed alongside the subsidiary's performance. This dynamic reinforces a fundamental truth about capital markets. Separation does not eliminate linkage. It redefines it. Investors understand that corporate actions are not isolated events. They are part of a broader sequence of decisions. Each decision builds or erodes trust over time. Ultimately, the success of this structure depends on execution and transparency, clear communication about intent, disciplined capital management, and a willingness to let performance speak louder than positioning all matter. Markets reward clarity. They penalize hesitation. A retained stake is not merely a financial instrument. It is a statement that remains on the balance sheet until proven right or wrong. And in public markets, statements are judged not by explanation, but by results. And this is where the story refuses to end quietly, because markets don't close chapters when the headlines fade. They open new ones. The real verdict is never delivered on listing day or in the first few weeks of trading. It's the live, read in earnings calls that test discipline, in margins that either hold or crack, and in guidance that either earns trust or exposes hope. That 50 million pounds position is still there, waiting, watching, measuring every decision, every forecast, every assumption. Will this company prove that independence sharpen its edge? Will it show that focus can replace scale, that execution can replace protection? Or will the market slowly realize that the story was priced faster than the reality could support? Because in the end, markets don't care how iconic a brand is. They don't care how familiar the product feels. They care about numbers, and numbers don't negotiate. This is the phase where patience becomes a weapon, where silence is louder than commentary, where those who rushed in begin to question and those who waited begin to move. And here's the truth. Most people miss. The most important price move almost never happens at the beginning. It happens when certainty breaks, when confidence is forced to reprice, when belief meets evidence. So as the charts keep moving and opinions keep shifting, remember this moment. Remember that before the crowd reacted, before the market chose a direction, someone was already positioned for what comes next. Because the real power in markets isn't predicting the future. It's being prepared when the future finally reveals itself. And when it does, only one side of the trade will still be standing.